You are listening to Keystone Stock Talk Podcast, episode 51. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week, in our Your Stock Our Take segment, we take a look at Covalon Technologies Limited, symbol COV on the TSX Venture, a researcher, developer, manufacturer, and marketer of patented products, medical products that improve patient outcomes and save lives in the areas of advanced wound care, infection management, and surgical procedures. This week, the company announced record Q2 results, and a listener asks us if we would still buy the stock. Our star of the week is Expel Technologies, symbol DAP.U on the TSX Venture. The company manufactures, sells, and distributes and installs aftermarket automobile products, including automotive paint protection film, headlight protection film, automotive window film, and other related products. The stock jumped 22% this week alone on very strong Q2 financial results, and it now is up 400% in 2018 on a year-to-date basis. Finally, our dog of the week is Kronos Group, symbol CRON on the TSX, a vertically integrated cannabis company with a presence across 4 continents. The company operates 2 wholly owned Canadian licensed producers regulated under Health Canada's Access to Cannabis for Medical Purposes regulation. While there has been a number of high flyers in this segment of late, Kronos was hit by a short report today and shares plunged 28% on the day in trading. Is it a dog now, or is there an opportunity here? We'll let you know. So let's dig into the show. I'd like to welcome back my co-host, Keystone's Senior VP and his Senior Analyst. It's Aaron Dunn.
Hello, Ryan. How are you today?
Very well, very well. Had some tremendous results out this week from a couple companies, some great gains. So it's nice to see for our clients, of course. So we're happy about that. And we're going to talk about a couple of those companies today.
Excellent. Well, it was generally a very strong Q2 earnings season for the recommendations across all of the services, the income stock, the small cap, and the US. We also had the Enercare takeout, which was really nice. That's a stock that our clients have owned from $9.50. So they've been collecting dividends off of that. Nice juicy dividend for the past 5-6 years. And then that is getting taken out at about $29 per share. And then also Parkland as well came out with really extraordinary results. And the stock has shot up a lot since the start of the year, since we recommended it in January.
Yeah, those results from Parkland were absolutely tremendous, and that really, really caught the attention of the market and boosted the stock, and it's done very well, in a short period of time. And speaking about doing well in a short period of time, we're going to talk about Your Stock Our Take this week. An email came in. The email was from, let me look here, Colin via email. Said, I picked up shares on Covalon a couple of years ago when you talked about it in a report that I got from Keystone. They put out what I thought were great financials this week. The stock surged. What is your take? It's time we answer a question on your stock in a little segment we like to call Your Stock Our Take. Buy, sell, or hold. So Covalon, symbol COV on the TSX Venture. Its current price is around $8.80. Market cap $191 million. What does the company do? They, like I said, they're a researcher, developer, manufacturer, and marketer of patent-protected medical products that improve patient outcomes and save lives in the areas of advanced wound care, infection management, and surgical procedures. They do business in the US, in Canada, the Middle East, Europe, Asia, Latin America, and a number of other international countries. The stock is up over 70% year to date. Much of this came from massive share gains that the company experienced in May when it won a series of competitive contract bids in the Middle East with an estimated sales value of $100 million over a 3-year period. Now, this week, Covalon released record quarterly results, which were received very positively by the market, with the shares jumping another 20% in the past 5 days. Those results, some of the highlights: $7.9 million in revenues, up 34%. Net income grew to $2.2 million, which is about 9 cents per share from just 2 cents per share in the same period of the prior year. And adjusted EBITDA was up to $2.7 million from just about $800,000. So tremendous growth there in the results. Now, Covalon has seen great share price gains in the last few months and over the course of this year, backed by large growth and a squeaky clean balance sheet. It is a very liquid balance sheet as well. The company's strong fundamentals and financial position, along with its $100 million contracts over the next 3 years, give it a great base to grow from. Its valuation is looking a little high based on the last 12 months, but if it continues to put up the numbers that it has in the past quarter, those numbers should drop as earnings catch up. Now, this quarterly profit, if it were to continue at this rate, could be a game changer moving forward in terms of valuations. However, we do note that about $4.5 million of the gains in the quarter came from a license payment, which tend to be lumpy in nature. Product revenues in the quarter actually decreased, but this was likely due to shipment delays on the Saudi Arabian contract. So they should be picking up in coming quarters. Covalon is a well-run growth business run by smart management, and the potential for growth here is real. At present, however, we would rank it a hold given the fact that it has very premium valuations and a bit of lumpiness in terms of the license revenues that we saw gains in that quarter that may not be sustainable near term.
I'm glad that you brought up the point about those non-recurring gains that or receipts of cash in the licensing. Yeah. Because that really happens all the time, and it's something that's important for investors to know if they're actually going to be looking at financial statements themselves, and to make sure that whoever they do have looking at financial statements for them is carefully analyzing the different points and where the sources of revenue are from, because some companies will report non-cash gains right up in the revenue line or somewhere along the financial statements to make them less obvious. And you definitely need to be aware of that, and you need to be able to strip those out. I mean, I've seen even companies post receipts that they've made from an insurance claim, for instance, not at all a part of their business, as a part of revenue, and you don't even actually see that in the financial statement. You actually have to go into the footnotes and read deeper to figure out that there's actually a lot of that revenue growth was actually just one of their facilities had a flood or something, and they got a big insurance payment from it. So definitely not a part of the business, not something we would consider revenue, and something that we would really just not even acknowledge as part of the ongoing operating capacity of the business.
Yeah, and so you see those headline numbers that look like shocking growth, and then if you dig a little deeper, you can find out there's some one-time numbers there, and you definitely have to do that when making any investment in any company. And it's the sustainability and kind of the quality of the earnings that the company is producing going forward. And that's why we love to see companies with recurring revenues. Like if you can see that, sticky recurring revenues, some of the companies with the SaaS or software as a service model, far more predictive. Now we are seeing very high valuations given to those companies, but you can see why, because of the predictability going forward. But you can't just pay anything for them on the other side too. So we want to look at quality of earnings, and you want to look at every company individually and analyze a report when it comes out to see where there's some one-time numbers in there. What is the sustainability of the earnings going forward? And those are keys when evaluating any stock. So we're going to move on to our dog of the week, and I'm going to let Aaron take that dog.
From our Stars and Dogs segment, it's time for this week's dog.
Excellent. So we are going to talk about Kronos Group. Symbol is CRON, C-R-O-N. It's one of Canada's multi-billion-dollar marijuana stocks, and it got clobbered today, down 28% in a single day. That's about $850 million of value lost. The company was hit with a short report earlier this morning, which alleged that they were misleading investors by not disclosing the size of the distribution agreement signed with the provinces. The stock started the day at over $16 and it ended at $11.77. And this is after a 120% run up over the previous few weeks with the rest of the sector. The question investors are asking themselves at this moment is this an opportunity to buy a multi-billion dollar marijuana stock at a temporary discount? So we've looked deeply into the numbers. The company does have positive revenues and posted massive sales growth in the last quarter. They reported $3.4 million in revenue compared to $643,000 in revenue in the same quarter 1 year ago. Great revenue growth, but the company is still losing gobs of money and reported negative operating cash flow of $20 million for the first 6 months of the year, plus an additional $38 million in reported investment expenditures. The cash shortfall was funded by $146 million in share issuances over the first 6 months. Looking at the valuation, the stock has a market cap of $2.2 billion, but they made only $3.6 million in sales for the last quarter. On an annualized basis, this would be a price to sales multiple of about 152 times, and that's an insane valuation relative to sales. Now, obviously, there is an expectation that sales are going to grow substantially, even exponentially from here. However, one of the things that we would look at to evaluate the growth potential of a company is the value of the contracts they're signing and the hard numbers that are underpinning their outlook. And the basis of the short report issued today is that Kronos is not making specific hard number disclosures around the contracts that it's signing. And these are disclosures that other cannabis companies like Canopy are generally making. So that's a problem with us. And in addition to that, for us, that's a problem. And in addition to that, Kronos is still trading at a price to sales valuation premium relative to the three top players in the space, which would be Canopy and Aurora. They're trading at about 120 to 130 times sales, and Aphria, which is trading at about 80 times annualized sales. You could make a lot of arguments that Kronos will rebound depending on what new news comes out over the next few weeks and few months, but that is just speculation. That is not investment. We wouldn't be buyers on this dip, and the big drop today makes the company our dog of the week.
That's a good synopsis. And I'm going to kind of make a little prediction here. I'm going to say that there are going to be a number of short reports released on some of the weaker players in this segment because there has been such a huge run up, and you're seeing, companies with limited revenues. Now there will, going forward when you hit recreational legalization, the projections are for strong revenues for these companies, but even based on some of those projections, the price to sales of these companies are so high right now that, based on no earnings, they're very vulnerable to a short report such as this, and, they can be opportunistic at this time, so you could see some extreme volatility in that segment, for sure.
I would say at these valuation multiples, they're really susceptible to a lot of different things, like any type of disappointment or setback or underperformance in a particular quarter, or if the legal industry doesn't ramp up as quickly as people think when legalization occurs. It's difficult for a fundamental investor to pay these types of valuations relative to sales.
Yeah, and I mean, just as a talking point, like the next stock we're going to talk about, which is a star of the week, I think you said the revenues from Kronos were $3.5 million for the quarter, and their market cap was what was the range of the market cap?
It's a little over $2 billion, about $2.2 billion after the pullback today.
So 69% growth in Expel, up to about 29 million. They did 29 million in revenue in the quarter. Very profitable, and their market cap is 194 million. So, I mean, you compare obviously different businesses, but two very high growth businesses. One is profitable, one is trading at a far significant discount. And that's after, like, the market cap on Expel is 194 million. That's after going up 400% this year. So, you see the valuations that one company is getting next to, this cannabis company. Both are high growth businesses. One has actual earnings, one doesn't, and one is far more susceptible, in our opinion, to those short reports. But let's take a look at our weekly star this week.
From our Stars and Dogs segment, it's time for this week's Star.
That would be XBEL Inc. DAP.U on the TSX Venture. Current price is $7. The market cap $194 million. It should be no stranger to our clients, as it was recommended just under a year ago when the shares traded at $1.42. Then in March, once again, it was recommended with the stock at $1.59. And in May of this year, when it crested $3, the stock was again recommended as a buy. The shares, again, closed today at $7. The stock was up 22% on Wednesday alone of this week and has gained 400% year to date, making it the single best performing non-penny stock on the TSX and TSX Venture this year. So let's find out what this little gem does. XPEL manufactures, sells, and distributes and installs aftermarket automotive products, including automotive paint protection film, headlight protection film, automotive window film, and other related products. Additionally, the company began selling commercial and residential window film and security film in 2018, just this year. Now, the company is in the United States, Canada, and parts of Europe, and operates primarily by selling turnkey solutions direct to independent installers and new car dealerships, which includes XPEL's protection films, installing, training, access to the company's proprietary design software, marketing support, and lead generation. So what's driving the stock? Simply tremendous financial results. The company just reported this week's Q2 results, which were record. Revenues were up to $28.9 million, up 69% from $17 million. Net income came in on a per share basis at 9 cents, up 200% from 3 cents in the same period last year. And adjusted EBITDA was up 137% to $3.9 million from 1.7. Now, management's outlook going forward, which, stocks are always priced on their earnings going forward and cash flows, it remains strong. As XPEL continues to grow, its fundamentals continue to shine. Its revenues and income are growing at a record pace, and its balance sheet remains clean and strong. Its growth, in fact, has made it the best performing stock on the TSX Venture in 2018. We are happy for these gains for our clients who have been in on this stock for over a year now. And now these gains this week make it our star of the week.
It's really amazing how you have sometimes these boring businesses that, at certain points investors don't want to pay attention to, but they're making gobs of cash flow and they're growing revenues, they're growing their earnings, and then all of a sudden investors start to notice, and these are often the best performing stocks out there.
Yeah. And it is. I love how you say nobody's paying attention. Literally zero coverage on Bay Street. Obviously, no coverage on Wall Street, but none in Canada. No analysts covering this stock. No estimates out there on the company. The company hasn't needed to go to the market to get funding, so that's probably one reason it hasn't had a lot of coverage. But you don't hear about this company at all on BNN or in the Financial Post or Globe and Mail. You don't see any writing or any analyst talking about this company. It actually gives you an opportunity to buy a mispriced stock, and that's why we were able to buy it. And over the last year, put out 3 separate buy recommendations to our clients, included in our focus buy portfolio, one of only 6 active buys that were in there over the last calendar year. Now, it allows you it gives you a chance to buy a stock which is definitely mispriced, and it was mispriced at the time, and it's had tremendous growth over the course of this year. And it's funny because you hear all the headlines about cannabis, blockchain, and all these other type of theme type investing scenarios, and what beat them all this year is a company that installs a protective film for an automobile, right? So if it's all about the returns, then investors should be all about a company like XPEL. And for me, it's all about the returns. So you'll know where I side on that.
As do I.
Yes, of course. And Aaron, I think that does it for this week. I'd like to thank you for joining me.
Thank you, Ryan.
And I'd wish our investors, profitable investing, but I'd like to also say keep those questions coming in to our Your Stock, Our Take segment. Email them or hit us on the regular social media channels. And again, profitable investing to all our clients and listeners out there.
Profitable investing.